Welcome, everybody, to today's call with Paul Sullivan, CPA and President of Sullivan & Company in Bethesda, Maryland. Since 1980, Sullivan & Company has worked to deliver solutions to help businesses and individual clients become more successful professionally and financially. They offer a broad range of services for business owners, executives, and independent professionals. In our call today is a little bit different format. We're going to talk a little bit about some tax updates and things that are timely right now here in the fourth quarter of 2012, just to keep you up to date. And then Paul may talk a little bit about, along with Raj Goenka, one of the senior staff accountants, and Bill Isaacs, who's a CPA and also the tax department manager. So with that, I'll go ahead and introduce Paul. Paul, welcome to the call.
How you doing? We're going to talk about the tax, just a few notes on tax updates as we approach the elections and what will happen in the beginning of 2013 should things remain the same. So covering this, I'm going to introduce Raj Goenka. Raj?
Hi.
Welcome to the call, Raj.
Thank you. I'd like to introduce some of the tax changes which might be implemented beginning 2013. As we all know, most of the Bush law tax changes are about to expire in 2012. And if they expire and Congress does not implement any changes or updates, the maximum income tax rates, which are 35% at the moment for 2012, they might go up to 40%. Anyone who is enjoying capital gain taxes of 15% might not be able to do so in 2013 when they go back up to 20%. Capital dividend rates, qualified dividend rates, might go up to 40%. And we are also talking about increased Medicare surtax on investment income of people who make above a certain range of income. And also Medicare payroll taxes might go up to 2.35% from where they are now at 1.45% for people who make above a certain amount every year. Many of the estate tax exemption, which is approximately $5 million at the moment, will fall down to $1 million at the maximum, and the tax rates for estates, which are 35% at the maximum at the moment, will go up to 55%. That means the IRS wants all your money. There have been many changes about foreign income and accounts, assets reporting. IRS is getting tougher and tougher every day now. We believe you are already reporting all your foreign income, but if you are not reporting your foreign assets, such as bank accounts, securities accounts that you might have in a foreign country, you should start reporting them now. The IRS wants a detail of what you have in other foreign countries if you are a U.S. resident or a citizen. If you are a U.S. citizen or a resident, you are by law required to report all your worldwide income when you do your income tax returns. But now with the tax law changes, you also have to report if you have any foreign bank accounts in a foreign country, or if you have assets such as securities, properties, investments in a foreign country, and if you meet the thresholds, you might have to report them to the IRS. There are no taxes imposed on the reporting, but the penalties may be much higher. So I believe these are some of the tax changes which might affect many of us middle-class Americans who are filing their taxes now. And I would suggest if you have been working with the CPA in your past or are considering working with a CPA, this is a very good time to consult them on how to take the maximum benefits of these changing laws, because we still have a couple of months left in 2012. With that, I would like to put Paul on with if he has any different tax law changes that he can make us aware of.
No, Raj, you covered it pretty good. I think most likely the one of the items is the capital gains will increase to 20% in 2013. And for qualified dividend income, it'll raise to 40%. So the people might want to meet with their accountants or meet with their investment people and restructure their portfolios.
Paul, a quick question on that capital gains. I've heard that there's a concept called gain harvesting, where you take a profit in anticipation of a change of the capital gain. Is that something that is applicable in this situation potentially?
Yeah, harvesting is where you have stocks in your portfolio that have a gain, and ordinarily, if you did not sell it, if you sold it, you'd pay the capital gains tax. But what you do is you sell some losses that are used up against the gain, and thereby there's no tax in the current year. And it's a common item that's done at the end of the year to use losses and balance them against gains. We're going to send a memo to our clients regarding identity theft. We had two situations this year where we just looked at them and just thought they were amazing, that what was done. And Raj handled one of those situations, and Bill handled the other situation. So what I'm going to ask them to do is just to find the basic scheme is trying to receive a refund from another person's taxes. So one situation we had, I'm going to ask Raj what happened, and if you could explain the details on how the person was trying to obtain money from IRS.
Thanks, Paul. The situation that I had was when we did their 2010 tax return, and they were carrying a balance forward to their 2011 taxes for the refund that they were supposed to get in 2010. All of a sudden, the client received two checks from the IRS. One of them was exactly the same amount for the tax carry forward that he had in 2010, and then another one was just an amount which he was not sure about. So his 2011 tax carry forward was approximately $16,000, and then he received another check of around $4,000, which he did not know what to do about. So he contacted us, so we looked into it, we talked to the IRS, and so we come to know that his taxes were filed for 2011 with certain amounts which were not his. So, and on the tax return, the 2010 carry forward was not claimed. So that's why the IRS sent him both the checks, one for his 2010 refund and for 2011, whatever was on the return. The returns were not filed by him. They were filed by someone else. So this is how identity theft comes into play. Someone who has access to your Social Security number, your name, knows something about it, they just put some amount on the tax return and put some withholdings or tax credits, and they will put the address thinking the IRS will send the refund check to the address they put on the tax return, which they do not know how the IRS works. The IRS will send the refund check to the address that they have on records until and unless you change it with them. There are certain forms you need to file to change those addresses with the IRS. So when identity theft happens, there are certain procedures you must follow so that it does not happen in the future. So we advise people should keep their Social Security numbers, keep personal information as safe as they can, because these situations are on the rise. If we look at last year when we had none, and now this year we had two situations as such, which we might think it may increase in the coming days. So I'd like to put Bill on the stand, and he would tell us about the other situation that we had.
Yeah, this case is actually brand new in that it came up yesterday. And how it came up was we e-filed this person's individual tax return. And after a day or two, we got a rejection notice back stating that a return has already been filed, or this Social Security number for the primary taxpayer has already been used on a return for this year used on someone else's return. So I called the IRS to find out what was going on. Did they really have a return so we could get this fixed? And they told me that yes, a return was received under this taxpayer's name and Social Security number with wages of a kind of a low amount, below $40,000, yet income tax withholdings of above $10,000, and there was an expected refund on this return. IRS though caught this. They flagged it. They thought it looked odd. And so they were holding on to it, and they hadn't done anything with it yet. They were still looking into it. There were a couple things that the IRS caught that caught their attention. Number one, again, the difference between the wage income that's being reported and the withholding seemed kind of high. The withholding seemed kind of high to the amount of wages that were being reported, and with some of the other deductions that this taxpayer was claiming. Secondly, there was a tax overpayment from 2010 that was being applied to 2011, and that was not even put onto the 2011 return. So the IRS thought that was kind of odd. So what that is going to make us do now is we're going to have to file paper returns for this client, and then there's another form that now needs to be completed and sent to a different office so that they can look into this and straighten this out.
To summarize those situations, basically somebody is making another tax return when they get somebody's name and Social Security number, and they just make it, and then they make the income low, and then whatever refund the IRS would be sent out, they're hoping that it's sent to the address on the return. So, for example, the first client Raj talked about, the client lived in Silver Spring, but the new address on the new tax return was in Capitol Heights. So they're hoping it goes to the Capitol Heights address, and then what they do is they take the check to one of these check cashing places, not a bank, and they try to cash that U.S. Treasury check, and it just amazes me how easy this seems.
IRS has many cases of these. They know they probably get I can't remember the number. They say probably in the millions of tax returns that they think they get that are not correct or identity theft. They really just don't have the resources to kind of track all these and make sure that these are correct or not, right, at this point in time. But they realize that this is a big problem with the IRS at the moment as far as identity theft and incorrect returns like this.
So from your standpoint, if you were to communicate to clients, is there anything in particular that you would say, such as if you get an extra check, don't know what it is, or other situation that they should contact you?
Oh, yeah, and I think that's what happened with the case with Raj. Is in fact, the client got a check, the one check that he didn't think he was supposed to be getting, and he was like, well, what is this for? And that kind of alerted us that, okay, something's going on here. And when we called the IRS, they said, well, he filed a 2011 return, and we knew that was false because we were working on it at the time. So, yeah, if they get a check, or they could just get something from the IRS that has nothing to do with maybe their situation, a notice or something like that for some reason, that they know that they had nothing to do with. All that could possibly be for someone doing something with identity theft. And even if you did receive that check and you think it's a blessing, even if you weren't supposed to get it, at some point in time the IRS realizes that they will come back to you. And will possibly charge penalties and interest. So it's good to get it cleared up immediately instead of just thinking, oh, I got this, great. It should be dealt with immediately.
Wonderful. Thanks, Bill. Thanks, guys. This has been the tax update for Sullivan & Company, CPAs. And, Paul, if somebody has a question, what's the best number and best email to use to get a hold of you?
My email is psullivan@esullivan.net, and my telephone number is 301-657-8080, extension 102.